Hi, good morning, and how's everyone doing? So, welcome to another beginner series videos. I am at the top of my voice because it's raining at the moment where I am. So, I hope you can hear me loud and clear, and I hope my voice can last the entirety of this video at this decibel. So I've been doing a series on financial statements. Last week, I talked about the income statement. Prior to last week, the very first video, I walked through and explained out what financial statements are, who uses them, where to find them, the Q's and the K's. So if you are watching on YouTube, go to the playlist section and then you see the beginner series and you can see the videos in order of posting. So today, I'm going to be looking at the balance sheet. Now, if you as I said, if you just join in, you can find the previous videos in the beginner playlist. Don't forget to like, share, and subscribe. The more you do so, the more YouTube rates this video higher in terms of views and ranking, and it then brings these videos to more eyeballs. If you have any questions, you can drop them in the comment section or send an email to info@greentickertales.com. Now, usually I would have this at the very end, but I'm going to be ending this video with a walk through different balance sheets. So that's the best way to explain how balance sheets work. So what's a balance sheet? In simple terms, a balance sheet is a statement of a company's assets and liabilities. Now, assets are easy to understand. Assets are things that a company possesses. Assets could be physical assets that you can see, property, plant, and equipment, or assets could be intangible assets, things that you can't touch and feel, but they belong to a company. So you have your trademark, for instance, your brand, for instance. Those are assets, and they're called intangible assets. Now, for liabilities are obligations to external parties. The most common definition or you'd see will be anything a company owes is its liability, while what a company owns are assets. But I choose to give a bit more context because people tend to put a negative connotation to liabilities, which is not the case. So liabilities are simply what you owe, your obligations. They are not negative. They are not a bad thing to have. Liabilities only become a problem if you have more liabilities than assets. And even in that case, like in the case of MTN, you'd see it was a momentary thing caused by the devaluation and all that. So that in simple words is what a balance sheet is. What are the alternative names for balance sheet? You can call it statement of financial position. You can call it statement of assets, liabilities, and owner's equity. And I would show you each part using MTN and Wema Bank as my examples. So what do the various parties look out for in a balance sheet? Everybody has what they tend to focus on. Like I said in one of the first videos, for some people, what they want to know is this company worth investing in? For some people, what they want to know is how much is this company generating? Can I lend money to this company? And for some people, what they want to know is it might even be what are their CSR obligations. You can find that in financial statements a lot of times. So for creditors, people who lend the company money or want to lend the company money, what they want to know is, do you have enough assets to generate cash? If you are barely generating cash, or in fact, in some cases, you barely have cash, why would I want to lend money to you? While for investors, a lot of times, especially in the Nigerian market, what people want to know is what's the quantum of retained earnings, past profits held by a firm? Will I get paid a dividend? Is this company generating cash? What's the cash is generating and all that? I mean, that's in the realm of the cash flow statement, which I will take in the next video. But you can have an inkling into it in the balance sheet. And then you also want to work out what's a firm's book value. A book value is simply what you would receive if a company is sold after deducting all its liabilities. So to calculate that, I mean, and the book value calculations, I would say, or using book value as a means of valuing a company doesn't apply to every sector, but it's very, very key, especially in companies in the financial sector and in the real estate space. So also importantly, a healthy company should have more assets than than liabilities. While for a young startup, or this should actually read more assets. So I can change this. Yep. So you should have more assets than liabilities and all that. And then for a young company or startup, or a company that's not even profitable, what I want to see is, do you have enough cash? Do you have enough cash to sustain you? Those are the things you look out for. So let's go look at examples. I used MTN Nigeria and Wema Bank in the previous video. I've skipped Apple. I'll come back to Apple in terms of cash flows and all that. So let's look at Wema Bank. Wema Bank is a bank listed on the Nigerian stock exchange. This is its statement of financial position, also known as its balance sheet. Can I squeeze it a bit? Yes. So let's blow it up so it's easier to read. Now, for a bank or a financial institution, the bulk of its assets are loans and advances to customers. That's one. Or two, investment securities. So you can see, for instance, with Wema Bank, the total assets is 3.9 trillion naira. And then of the 3.9 trillion, almost half of its, or just a bit over half of its assets are loans and advances to customers. So why are loans and advances to customers assets? It's quite simple. Banks generate interest income from loans and advances to customers. They also have all sorts of fees that they charge in processing loans and all that. So that's why for a bank, these are loans and advances to customers are an asset. What else do you have? You can see that investment securities, and we have a split. Investment securities held through fair value through other comprehensive income, fair value through profit and loss, and then held at amortized cost. So they each mean different things. Held at amortized cost simply means that these are assets that, or investment securities that we're going to hold till maturity. While for those fair value through profit and loss, what it simply means is that if I want to put them there, it's simply because they are in the company's income statement. Now, there are assets that I'm continuously measuring. Now, for the assets held at amortized cost, I don't need to measure the ups and downs, the changes in valuation, because I'm holding them for maturity, I'm holding them for income. So that's the thing. While for assets held through fair value through profit and loss, commonly known as FVPL, I'm measuring the direct changes in the ups and downs of the value of that asset in my income statement. Last episode was on income statement. While those held through other comprehensive income, known as OCI. OCI simply means that the gains and losses on those assets, I'm either going to transfer them to retained earnings upon sale or reclassify them. So that's the difference. But let's not get into the technicals there. I think at some point in the near future, maybe when the the rest of the Fugas numbers are out, or the UGAs, you can call them UGAs, UBA, GT Access, and Zenith. Once the numbers drop, I would then go through them. But you can see that investment securities amount to what? This is about a bit over $1 trillion. So you have essentially 4 trillion balance sheet. Almost half of that balance sheet is in loans, and then the rest is in investment securities. So you have almost 2.9 or so trillion investment securities. Now you have restricted deposits with the CBN. That's a whole episode on its own. Now banks have to hold cash with the CBN for regulatory purposes. And some people have argued that look at the quantum of cash, because if you're having almost a trillion naira or almost 900 billion sitting with the CBN, you can definitely do better with that money, because you're earning sometimes next to nothing on that money. But that's on the asset side of things. On the liabilities side of things, you can see here now that liabilities, the bulk of the bank's liabilities, are deposits from customers. Why are they liabilities? They're liabilities because you pay interest, you earn interest, or you pay interest to depositors who give you their money. So you can see clearly that liabilities are not a bad thing. They are not a negative thing. They are simply your obligations to different parties. So the bulk of liabilities uh, for a bank, in this case, Wema Bank, bulk of liabilities deposits from customers, very little deposits from banks and all that, which is kind of normal, right? Now, when you deduct liabilities from assets, what do you have? You have book value. And so the book value you can see is total assets 3.9 trillion, total liabilities 3.6 trillion. What do you have? You deduct that, you should have somewhere around 323. Now, definitely your book value, what you then have, it then also equates to your equity. So clearly that's why you can have your total assets, total liabilities, deduct, you have your equity, in this case, your book value. So if I want to now say, look, based on the information in the balance sheet, what's the book value per share of this bank? And it's quite simple. I take the 323 billion, and we can do the math, and I'll just walk you through. Since this is a financial company, then yeah, for valuation purposes, your book value is quite useful. So we go to Wema Bank. I'm sure you can find these numbers deep down in the current financial statement, but it's just easier to walk you through, and it's also a way of teaching and explaining and all that. So I think the number of shares issued should be maybe in the 21 billion. So to work out the book value per share, I take and you can do the math, 323 billion. I can say I did it before in preparation for my videos, divided by 21.4 billion. So the book value per share of Wema Bank is what? 15 naira. But I think let's see what the bank closed at on Friday. So Wema closed at 21.95. That's 22. So if I take 22 divided by 15, that's about 1.46 times book value. So you might say the stock, well, it's a bit pricey. It's not overly overpriced, because I mean, underpriced on the value is when your stock is trading below book value. Overpriced, you may say, it's trading largely or fairly way higher above book value. So your book value, you put it at 1, it's trading at 1.4 times or 1.5 times book value. It's not, I mean, it's a bit expensive, but it's justifiable looking at the pace of the company's growth and all that. So for me, like I've always said, I think if I were to look at this firm, 17, 18, sure, then it starts to look interesting, because I really don't, because that's closer to book value than where it is at the moment. Now that's for Wema Bank. Let's look at MTN. What do we have? Okay, that's the income statement. So now you now have your assets, 4.7 trillion in assets, and you can split assets into current assets, non-current assets. Current assets are those that have a lifespan of a year or less. Anything above a year in terms of lifespan comes to, or is classified as non-current assets. But you can see clearly what's the bulk of assets owned by a telco. Telecommunication space is a very asset, especially physical asset heavy space. So while you saw with Wema Bank, and let's go back to Wema Bank, you can see clearly with Wema Bank that they're not very heavy on physical assets. The bulk of assets owned, in fact, physical assets, property and all those things, 62 billion, right of use assets, 1.3. So that's like maybe 63 point something, and physical assets, they're not very heavy on that. But a telco space is one that is very, because it's telecommunications, you have base stations, you have other equipment, right of where you have your fiber cables running and all that. Very heavy on physical assets. Property and equipment, 1.6 trillion, right of use assets. And so when we use the term right of use assets for a telco, it simply means that you have equipment or property. In this case, for telcos, you have fiber cables running through different parts of the countries. They pay fees for that to use to have your cables and equipment passing through the ground. You pay fees. It's not for free. So under that, you have your right of use assets, and then you have other equipment you're leasing, like property and the whole things. So the telecommunication space is very heavy on assets. So 4.7 trillion in assets over, I mean, you can add up 1.6, that's 3.2. Over 70% of that is physical assets. So if I want to value MTN, you're not going to use a book value kind of a thing and all that, because really the bulk of that's not where the core of business is. It's not in the assets, or it's not in the worth of the asset, the physical asset. It's more about how much are you generating. So a cash flow calculation is a better way. If I take the cash flows and I can use that to then value this firm and all that, I can even take revenues, or can take profits. So not the physical assets, because they are heavy on assets and all that. Now let's look at liabilities, or let's dwell a bit on physical assets. You have your non-current assets, property and equipment, right of use assets and all that. Current assets, what do you have? You have trades and receivables. Now receivables is money that a company is being owed. So it's nice to see that. And I'll probably go down and further break it down. So in terms of receivables, what do you have? Receivables are down. Trade and other receivables are down. That's always a good thing. And then what do you have again? Cash held for Momo customers. Momo is the payment service bank for MTN. So cash is up. I mean, that's a good thing. If you have more cash being held, that's either more users on your Momo platform, or more money by the same band of users as well. Then cash and equivalents, what do you have? 257 billion naira in cash. Now let's look at liabilities. The biggest bulk, can I blow this up? Okay, let me blow it up, then I'll scroll down. So for liabilities, non-current liabilities, what do you have? Lease liabilities. Telcos do a lot of leasing and all that, base stations and all those things. So liabilities are up, but marginally up from December 24 to June 25. Employee benefits and all that. So non-current liabilities, they are not a biggie as well, because you have over a year. Now, current liabilities, trade and other payables, what do you have? It's up, marginally up. Marginally up, 1.1 trillion to 1.3 trillion, not bad. Borrowings are down. You have lease liabilities and all that. Deposits held for Momo customers, that's what? Sharply up. Quite interesting. Why does it repeat itself twice? Okay, so current assets, cash held for Momo customers. Is there a difference between cash held for Momo customers and deposits held for Momo customers? I'm not clear myself. Interesting. I probably need to reach out to the MTN team, or reach out to telco analysts to help me break that down. But clearly you can see, now in this case, I'm going to explain something. You have total assets 4.7 trillion, total liabilities 4.8 trillion. So you have liabilities slightly higher than assets. And why is that the case? Let's see if we can zone down. Liabilities went up from 4.6 trillion to 4.8. Barely, that's really a tiny increase. Now let's look at assets. Total assets went up as well. Now the weak point, you might say, is in the losses, accumulated losses that you see here, and these losses are largely to the FX devaluation that you have. So when you walk it through, on face value, you can't just say, oh, more liabilities and assets, so this is a bad company. No. And that's where your cash flow statements, if a company is generating decent cash, you have profitability and all that, these issues tend to balance itself. So I hope you found this useful. As always, if you have any questions, please feel free to share. See you next week. Next week, I'll be looking at the cash flow statements. Have a great day ahead.